All right, so in this video, I'm going to talk just briefly about Federal Reserve history. And the Federal Reserve was established in 1913, and that was done to more effectively supervise banking in the United States, basically because there had been a whole series of previous panic periods. And typically, what would happen in some of those prior bank panics would be something kind of like this. There'd be some kind of sharp increase in business, generally due to credit abuse. In other words, lots of borrowing and investing and things like that. And then something would happen. And whatever that was, it would trigger a loss of confidence in local businesses or what have you, and the economy as a whole. And what would happen is there would be a run on the banks. And so what would happen in the run on the banks is basically people would run to the bank, they wanted to take their money out. Now, banks don't keep all their money there in the vault. The whole point behind the bank is basically you take your, say, $1,000 and you put it in the bank. The bank takes that $1,000 with a whole bunch of other money. They package it together to lend it out to some business or maybe somebody buying a house or something like that. And then they pay you interest on your $1,000. So the bank has some money on hand when people want to make withdrawals, but they don't have all of it, because if they had all of it, they wouldn't be paying you any interest. The whole reason they're able to pay you interest on, say, your savings account is basically because they took that money, packaged it with a bunch of other people's money, and they lent it out, right? So if everybody shows up all at once trying to take their money out, this creates a problem because the bank doesn't have the money for everybody. They lent it out to other people, right? And so that would be called a run on the bank. And what would happen is basically when there was a big run on the banks would be running out of money that they had on hand to pay out to all these depositors who are trying to pull their money out. And so the banks would put pressure on short-term borrowers because they need to try to call in those loans and basically get that cash to give out to all those depositors. That would push companies into bankruptcy. More companies would go into bankruptcy. Then we'd have people who are unemployed. And when unemployed, guess what? They need to take money out of the bank. And so then they go try to take money out of the bank. And so you just have more of a cycle, and it would just turn into kind of a mess, right? Now, as a little side note here, if you ever watched the movie It's a Wonderful Life, with the Bailey Savings and Loan, a run on the bank is one of the things that happens in the movie, where basically everybody shows up trying to take the money out, and George Bailey's trying to persuade people not to take all their money out, because if they all try to take it out, it's going to collapse the savings and loan, basically. Now, what they have at this point for banks is the FDIC, so the Federal Deposit Insurance Corporation. And basically, this is a federal entity. And basically, unless you have over a certain amount of money in the bank, I think it's well over $100,000 or $100,000 somewhere in there. I think it might be closer to 250 now. But anyway, if you have thousands and thousands, unless you have thousands and thousands of dollars in the bank, basically what the FDIC says is unless you're over the limit, then essentially, if your money's in the bank, the federal government is essentially guaranteeing that you're going to get your money back. So even if there's a run on the bank, even if the bank closes, if it's an FDIC insured institution, you're going to get your money back. And that's the basic idea. And so the government basically says, we will step in and make sure you get your money. Now, the bank may have to close for a couple of days while the regulators step in and figure out what's going on at the bank and so forth. But the few times that has happened historically, generally, we're talking just literally a couple days time before the bank is up and functioning again and people can access their money and so forth. So realistically, at this point in time, if you have your money in an FDIC insured bank, there's really kind of no sense in doing a run on the bank. Unless you don't think the federal government is going to backstop it, in which case, if you think that's the case, then you got much bigger problems, right? Because if they aren't backstopping it, then we got bigger worries going on here, and there's a much bigger systematic problem. Now, although the FDIC kind of protects against those runs, and you shouldn't need to worry about the run there, it doesn't actually prevent them. So it's still possible that people could engage in a run on the bank, despite the fact that the federal government is basically saying, hey, we got you, you're going to be fine, if it's an FDIC insured institution. So technically there can still be a run, but the FDIC insurance basically means you don't need to worry about it as an ordinary bank account holder. There might be a disruption for a couple of days, but that's about it. Now, in order to try to break out of some of this, the Federal Reserve was created partially to kind of start regulating banks and make it a little bit more ordinary and things like that, but also to serve as essentially a lender of last resort so that instead of having this situation where banks start collapsing and failing, and then that leads to basically people who don't have their money, and businesses then fail because they don't have their money, and then more people get unemployed and more withdrawals and more bank failures. It basically just snowballs out in this big mess. So basically, the Federal Reserve, one of the things they were created to do was to be a lender of last resort. And basically, they could step in and essentially lend money to a bank to basically say, here's cash, basically, just so that you can get through this mess and everybody calms down and stops trying to pull all the money out. And so we can get everybody to calm down long enough that we get past that and it doesn't turn into a giant systematic mess that crashes the economy. And so that was one of the reasons why it was created. It was to create that lender of last resort situation to try to help stem off any big effects from snowballing into something that crashed the whole economy. And that was kind of the idea. All right, so hopefully this helps explain kind of a little bit of the history and kind of why and motivation for why they did some of the things they did with creating the Federal Reserve. Thank you so much for watching and have a great day.